You see the headlines every single day, right? Inflation is hot, the job market's cooling down, but what does all that jargon actually mean for the economy, and more importantly, for your wallet? Well, in this explainer, we're going to pull back the curtain and demystify the key vital signs that really move the markets. Let's jump right in. Look, every day we are just bombarded with a storm of data and acronyms. CPI, NFP, PMI. It's enough to make your head spin. So the real question is, how do you cut through all that noise and get a clear picture of what's actually happening? That is exactly what we are going to break down right now.
All right, think of this as a complete economic health checkup. First, we're going to take the economy's temperature by looking at inflation. Then we'll check its pulse with the latest jobs data. After that, we'll pop the hood and measure the power of its engine with growth indicators. And finally, we'll put it all together to diagnose exactly where we are in the business cycle.
So let's think about these key indicators as your dashboard for the economy. Each one is like a different gauge: oil pressure, engine temp, speed. And while each one tells you something important, you need to look at them all together to really understand if you're cruising along or headed for trouble.
First up, inflation. This is like taking the economy's temperature. Is it running hot, a little too cold, or is it just right? See, a little bit of inflation is actually a sign of a healthy, growing economy, but a high fever, that can signal some serious problems ahead. The one you hear about all the time on the news is the CPI, the Consumer Price Index. The easiest way to think about it is this. Imagine a giant shopping cart filled with all the stuff a typical family buys. We're talking groceries, gas for the car, rent, you name it. The CPI simply tracks how the price of that exact same cart of stuff changes from one month to the next.
Now, here's where it gets a little more interesting. You'll always hear about two different flavors of CPI. The headline number includes everything in that shopping cart. But because the price of gas and food can go totally wild from month to month, economists also look very closely at core CPI. Core just strips out those volatile items, and that gives them a much clearer, more stable signal of the real underlying inflation trend.
But okay, here's a little inside baseball for you. The Federal Reserve, the institution that actually sets interest rates, they have a preferred inflation gauge, and it's not the CPI. It's something called PCE. It's a much broader measure. And here's the kicker. The Fed's official 2% inflation target is based on PCE. So when the Fed is making decisions, this is the number they're obsessed with.
So what's the big difference? Well, CPI really just tracks what we pay for stuff out of our own pockets. PCE is way broader. It includes things our employers might pay for, like health insurance. And maybe most importantly, PCE is smarter. It adjusts for our changing habits. So if the price of steak goes through the roof and everyone starts buying chicken instead, PCE captures that shift. CPI doesn't. And that's a big reason why the Fed trusts PCE to make its policy decisions.
Okay, let's move on to our next vital sign. We've taken the temperature, now it's time to check the economy's pulse, the labor market. Is it strong and steady, or is it faint and weak? A healthy pulse means a healthy economy.
And the big one here, the number that stops the market in its tracks on the first Friday of every month, is non-farm payrolls, or NFP. The question it answers is incredibly simple, but also incredibly powerful. How many jobs did the U.S. economy add or lose last month? It's our first best look at the health of the workforce. So let's say the new report drops, and boom, the number is plus 250,000 jobs. Now, is that good? Is it bad? Well, here's the thing. The number itself is really only half the story. The other, arguably more important half, is how it compares to what everyone expected it to be. So in this case, the market was only looking for about 180,000 jobs. The actual number, 250,000, blew that expectation out of the water. In market speak, that's a huge beat, and it tells us the economy is running much hotter than analysts. So what does a hot number like that actually mean? Well, it's kind of a double-edged sword. On one hand, it's fantastic news. More people have jobs, the economy is resilient. That's great. But on the other hand, it can spark fears of inflation. A super tight job market means companies have to pay more to find workers, and those higher wages can end up pushing prices higher for all of us. And of course, NFP is just the headline grabber. To get the full diagnosis, you gotta dig deeper. We also look at the unemployment rate to see just how tight the job market is. And maybe the most critical piece of the puzzle right now is average hourly earnings. This tells us how fast wages are growing, and that's a massive clue about where inflation might be heading next. All right. On to our third vital sign, economic growth. This is all about measuring the raw horsepower of the economic engine. Are we accelerating hard, just cruising along, or are we starting to stall out? And a fantastic tool for this, one of my favorites, is the PMI, or the Purchasing Managers Index. What's so great about it is that it's forward-looking. Instead of telling us where we've been, it gives us clues about where we're going. It's basically a survey that asks business managers, hey, are things getting better or worse? And because it comes out super early each month, it's one of our very first peeks at economic momentum. Now, with the PMI, you can forget all the other numbers. There is one number to rule them all, and that number is 50. 50 is the magic line in the sand. It is the absolute key to understanding this entire report. And the logic here could not be simpler. If the reading is above 50, it means the economy is expanding, things are growing. If the reading is below 50, it means the economy is contracting, it's shrinking. That's it. That's the whole game. When you see a PMI report, the first thing you look for is which side of 50 it landed on.
Okay, team, we've checked the temperature with inflation. We've taken the pulse with the labor market. We've measured the engine's power with growth data. Now, it's time for the final diagnosis. Let's put all of these vital signs together and figure out the bigger story, the business cycle. You see, economies tend to move in a pretty predictable cycle. It all starts with the recovery phase. This is when things are just starting to bounce back. Our PMIs climb back above 50, the job market starts healing, and inflation is usually pretty low. Then we move into expansion. This is the good part. Growth is solid, jobs are easy to find, and this is when inflation starts to creep up. After that, we hit the late cycle. Growth starts to lose steam, our PMI numbers might start to dip, but inflation can often stay stubbornly high. And finally, you have a recession or contraction. This is when our PMIs fall below 50, the economy is actually shrinking, and people are losing jobs. By looking at all our vital signs, we can make a pretty good guess about which one of these phases we're in. So why on earth does any of this matter? What's the point? Well, here it is. Every single one of these data points sends massive ripples through financial markets, from the price of stocks to the value of your currency. Understanding the data is the first step to understanding why markets are moving the way they are. So let's boil it down with a quick little cheat sheet. Generally speaking, when data comes in hot, meaning it's way stronger than expected, that can be a sign that inflation is heating up. That often causes interest rates to rise, which can be tough on the stock market. A hot jobs report can spook the market into thinking the Fed is going to have to get more aggressive. But on the flip side, hot growth numbers, like a really strong PMI, can be amazing for cyclical stocks. Those are the companies whose fortunes are tied directly to a booming economy. It's always a balancing act. So there you have it. You now have the dashboard. You know how to take the economy's temperature, check its pulse, and gauge the strength of its engine. The next time you see those headlines, you won't just be a passive observer. You'll be able to make your own diagnosis. So I'll leave you with a question. Based on everything you're seeing out there right now, what phase of the cycle do you think we're in?